Right. Happy Monday, everybody. Welcome to today's episode of Crypto with Chris. So today we're going to take a look at recent price action over the past week. And then I think after that, I wanted to poke around and just show a couple of cool trend indicators that I use from time to time. I have got like a whole big stack of indicators that I sort of have enabled on every chart, but I only have a handful of them ever enabled, like visible at any time. But I've got a bunch that I kind of toggle on and off and look at, and I wanted to show some of those because I think there's some cool stuff out there. But of course, before we get into that, all the reminder stuff as usual. Follow me on Twitch, follow me on YouTube, follow me on Telegram. Those are the main things. Basically, you need to be a follower in order to comment in my Twitch chat. But literally nobody ever does. Secondly, all my videos get uploaded to YouTube after I do them on Twitch because Twitch doesn't store them. So they end up on YouTube anyway. And then lastly, all my Telegram alerts basically notify you for all the stuff that I'm doing. So the links to those are in the description and in the description of each video. Yeah. And then in my Twitch channel too. So anyway, all right, let's go. Okay, so we'll start on the weekly here. So it's funny. It's last week, I think around the time I did the video on Wednesday, we were like right up at the top of this trend line here on the daily, and we were bumping up against it. And what do you know? The week ended red, kind of just like I thought it would. We kind of just have mean reverted back down to, basically this support level we were at. But I wanted to touch on the cycle first, just to kind of talk about where we're at in terms of the 60-day cycle, because I think that's relevant at the moment. So if we look here, so what are we on? We're on day 34. Okay, so that kind of makes sense. So typically around the middle of the cycle, right around day 30, you tend to get like a bit of a pump. You get like a second half, pump leading into the second half of the cycle. And I feel like we kind of got that here. It came up, it basically tapped the bull market support band again for the second time after touching it here. And it got pretty firmly rejected, I would say. And it's come right back down to the 20-day moving average. It closed actually below it. And right now it's kind of sitting right at the 20-day moving average, which is the mean, essentially. Also right in this sort of general support range. So one thing to keep in mind is if we kind of consider the fact that, as of now, we're operating on the assumption that we peaked on day 7. And unless we come back and set a new higher high in the second half of the cycle, which, of course is possible. But until that happens, or even looks like it's remotely going to happen, I'm going to operate on the assumption that it's not going to happen. So that said, if we operate on the assumption that the high was in fact on day 7, that means we've got essentially, 53 odd days of downside, ultimately, whether that means sideways or whatever, just lower than we had on day 7. So when you think about that, where are we now? Again, day 34. So what happens if I go like the, oops, well, whatever. Again, starting from today. 26. So that's actually past the ETF deadline, which is on the 16th or 17th, coming up next. So here's kind of what I'm thinking in terms of that. If we get the yes, obviously I think we're going to see a big pump. How big is that pump? I don't know if it goes up and sets a higher high. It could wake up there. The more we kind of go along, though, when I look at other economic factors that I'll kind of touch on in a minute, and other sort of even technical and on-chain factors, the less I see the idea of an ETF approval sort of launching us into the bull market. The big parabolic run. It's still too early. It's still way too early. Obviously, it will have a positive effect. But what I think will happen is we'll get a big pump up, and then I would not be at all surprised if it just kind of played out kind of like these last two big chunks have. Big pump up, kind of just slow fade. Big pump up, kind of just slow fade. We'll get a big pump, maybe sort of a triple top, maybe a higher high, and then it'll be a slow fade. So into the end of the year, basically. So effectively what that'll do is that'll increase the floor. That'll raise the floor price, but it's not gonna, again, be the sort of the catalyst. Conversely, if they get delayed again, there's just so much apathy in the market right now, everywhere you look, that I feel like if we don't get it, it's just this is where it comes down to these lower levels here. And I know I've taught, sorry. I know I touched on in previous episodes the idea of, this notion here of anytime we do a crossover, the 20-week moving average, it's done a 50% correction, which would put us at basically a new low. I'm not going to rule that out definitively, but I think the odds of that happening have kind of gone down a fair bit. I feel like if we were going to do that, we'd kind of be more steadily heading in that direction at this point. So then I kind of come up and I start looking at these two levels here, this sort of 19.5 and this 21. And right now, my sort of base case is that we bottom out somewhere around the 20K level, like almost, that would put us, well, actually, if we go back to here, if we look at this other one where we talked about the Death Cross, that actually puts us here. Let me kind of zoom in on this. So and I'm basing this 26% here on, well, not much, but the other precedent being sort of the last time we crossed below the 20-week moving average at sort of this same time in the cycle, at this sort of same phase, this pre-halving year initial pump, second half of the pre-halving year sort of dip down. And in that scenario, we went down 26.8%. So that's really all I'm basing this on. Which is obviously nothing. That's a minimal sample size. It could be anywhere in this range, but I'm just kind of using it as a frame of reference. But if you look at that, that puts us kind of right near this other support level that had formed here, kind of right around the 20K level. I mean, yeah, this goes a little bit lower, but seeing 20K kind of seems like a big, nice round number that makes a lot of sense. So if we go back to here, I'm not going to draw a trend line here, whatever. But I do think that, somewhere in the ballpark of 20K is a very reasonable, likely scenario for a landing spot for this in the event that the ETFs get delayed. Because you have to remember, if the ETFs get delayed, there's no more deadlines through the rest of the year. I think the next deadline after that isn't until like the middle of January or the beginning of January, somewhere in there. So like this is it for the year. If it's not this one here, then it's done. And so it's kind of like no more catalysts at the moment are in place. And so really that kind of just brings us back to the technicals. And so and right now the technicals have reversed. If you do go back and look again, it's in the first year of a new cycle. That pre-halving year, it's not at all uncommon to spend kind of 6 months going up and 6 months going down. Or even if you go back to 2015, although I don't think this chart does, barely, you get a double bottom. You get the bottom right coming in, and then you get another kind of double bottom here. So it's, I'm kind of operating on that assumption here that, through the end of the year, yes, I know people say historically October is like the best month. I wish I have this chart somewhere. I don't have it handy. I should have pulled it up. But yes, in general, historically, October and November can be some of the best months for crypto. But there are exceptions to that. There are exceptions like pre-halving years. And if you look at, this October here, here, let's just go to the monthly and we can just see. What do we got here? Well, sure enough, now I look stupid. Okay, so October was a green month here, but it was in the overall downtrend, and it did actually trend down for the entirety of that year, the second half of that year. That's sort of funny, though. It's funny because if you look at the weekly, it didn't look like that. But Sure enough, it made me a fool. Anyway, you can see though, regardless, it is a downtrend starting from, June, July, and then boom, all the way down to the end of the year, with randomly October being a green month. But that's funny. And then kind of here, we got October, August, September, October. Well, what do you know? October, big green month here too. So I guess what the hell do I know? Whatever. It's just, it doesn't mean it's a precedent necessarily. Let's go back to the weekly though. I'm kind of laughing at that. So I don't know, maybe we get a bump in October. Regardless, I still think that, my thesis still stands that it's all come down to the ETF approval. We go up, but we go up, but then we fade and we level back off through the end of the year. ETF delay, and we come down into this range here, somewhere, by the end of the year. So what I'm going to do, how I'm going to play this, not being financial advice, but how I'm personally thinking about playing this is really just kind of, obviously waiting until this deadline happens, because I'm not going to do anything until then. I'm sitting mostly in cash right now. But again, if we do get the delay, I'm going to, essentially look to sort of DCA effectively by staggering a few different orders at different price levels, throughout this range here from like 2021 to like 19.5, kind of somewhere in here, and just sort of look to accumulate in this range. And then if we go below this range, I'm okay with that. Like you have to kind of weigh, do we think we're actually going to go down here versus, well, I got to buy sooner or later and I don't want to kind of miss the boat. And you have to sort of compromise a little bit and accept the fact that, well, maybe if you buy here, it still does go down here, and you just have to be okay with that. And I would be okay with that because, again, I sold up here. So if I sell up here and I'm able to buy down here, that's like a solid 20-25% gain right there. And I would be stoked if I could do that. That's great. I'll take that all day long. Even if it goes down another, whatever, 10%, and I'm not able to scoop this up, that's okay. I can live with that because I know ultimately it's going to go up and it'll be fine. So this is the range I'm looking at. And I honestly hope it gets down there because I feel like if the ETF deadline, or if the ETFs do get approved, it's just really going to just kind of cloud the situation more than anything. It's not going to be like, yes, it's good. Well, it's good for price anyway. Yes, we need it in terms of sort of greater mass adoption. But right now in this moment, at this stage of the cycle, in this pre-halving year, when we're sort of used to a sort of pattern that unfolds, this is going to throw a big wrench in that, particularly if it comes up and sets a new high, and I just, whatever. It's just going to make things more difficult to manage, essentially. So honestly, what I'm going to do too is coming up to this, I'm probably going to put a buy order in like a little bit above wherever the price is, just in case it does get approved. It'll catch it on the way up and I won't get caught out that way. Even though in the back of my mind, I have a pretty strong conviction that, like I said, it's just going to pump up and then probably fade back down to this same level. I would not be at all shocked if we get an ETF approval and we finish the year right now at this same level we're at right now today. That would not surprise me at all. Not in the least. So, but we'll see. Really what an ETF approval is going to do isn't going to start this bull market. It's not going to be the catalyst, but it's just going to totally juice the bull market once it does come in. Once we do get past the halving, once it kind of the Fed sort of pivots and, monetary policy changes and sort of things pick up a little bit from a global liquidity standpoint and things like that, the business cycle start picking up steam. That's when we're going to see things go. And it's really going to be not just crypto, but everything across the board. And so that's when the bull market is going to kick in, probably again, like, 8 to 10 to 12 months from now. But having this sort of kick in right now is just going to be confusing. But we'll see how it goes. I did want to kind of look at this on the daily. So yeah, this was interesting too. I was kind of, well, I don't know if pleased is the right word, but not surprised rather. When this was coming up, I think, what was it, Wednesday, Tuesday? So Wednesday, the day I did my show on Wednesday, it ended up getting totally rejected, and it was right up there. And now we had a big, 3-flag hidden divergence, bearish divergence flag come up, and it's just boom right back down since then. And as we can see, like I said a minute ago, we're basically sitting right at the 20-day moving average as resistance right now. So yeah, so I mean, this bull market support band continuing to provide resistance. The 20-week moving average, which is this red line, continuing to provide resistance. Even the 10-week moving average, which I think we actually came up, if I'm not mistaken. Yeah, we came up, and you can kind of barely see it. It's this green moving average line here. It came straight down. But we literally went up and tapped it perfectly and got rejected on it on the 10-week moving average, which also is a strong sign that, until proven otherwise, we're headed down. I mean, everything's pointing down from a technical standpoint. Yes, there are arguments to be made that there's the situation is getting untenable for the Fed to continue to stay within the regime that they're in, and that they'll be forced to flip soon, and that's going to just cause everything to rocket. And I don't disagree with that, but I think that obviously until that happens, the trend is down, and you have to kind of abide by the trend. And so that's what I'm doing, and that's my bias. So I'm ready to quickly pivot if need be, but I'm not going to be betting to the upside before then. So again, looking back at this, we still we've still managed to close above this weekly cycle invalidation level, which is basically the bottom of this wick right here from this previous weekly cycle closer. And that's interesting to me that it's sort of has held as, major support here. But I think we're going to come down and retest it again. That's where this line is trending here on the bottom. And that's, after this rejection, I think that's sort of the next step down. Now, do we break it? I don't know. You have the old adage of there's no such thing as a triple top or a triple bottom. Typically, once something does two major touches on a trend line, the next time it's going through, just like we had, with the top here, it's going through the next time, whether it's going up or it's going down. So, and right now it's headed down and the trend is down. So, chances are pretty high. I feel like that the next time we come down here, we blow through this, and outside of the ETF situation, I think we go lower, and so that's going to kind of put us into this no man's land, really, between this level and this level here. So I don't think that there's going to be a lot to hold us in place here once we kind of get into here. I think it's going to probably move fairly quickly. Of course, I could be wrong, and we'll go sideways for 6 months like we do. But, that's kind of the things I see when I look at this. A couple other things interesting that I noted in the last week. I noted on Friday when the markets closed, the stock markets. So what we're looking at here is the three major U.S. stock indices. We got the S&P, the NASDAQ, and the Dow. And they all put, they all put bullish divergences, some actually quite big. In fact, the NASDAQ was really interesting. Not only was it not like hidden divergences like these, sort of less reliable, but it was a big, dark 5-spot, regular bullish divergence. Which, it doesn't do that very often. I mean, the last time it did that was way back here, and, look what happened after that. So, and then way back here, and, even look what happened there. So, and then if you go back to, well, what do those really mean? And remember, I faded this one here. We had this five spot here, and I ignored it, and to my peril. So I think this is something that's noteworthy. I mean, who knows what will ultimately happen, but I'm paying attention to this. And then we got a slightly smaller one on here. Oh wait, granted, these are on daily, and that was on a weekly. Well, whatever. It's still noteworthy because it doesn't happen very often. And so, do I think we see a bump in stocks? Yeah, actually. Although I wanted to look at the dollar index because it's continued to show strength. It's done this thing on the weekly, which is kind of interesting, actually. So, what are we at? Like, how many in a row is this now? This is kind of crazy. 10 weeks in a row. So, well, including the current week. But we're looking at 10 weeks in a row now And I know it's put up this flag actually a couple of times prior in these previous weeks, and it just keeps pushing up. But we'll get these big long wicks down, you know, in these, and it just like you'll see it kind of, you know, get depressed throughout the week and then just rally by the end of the week and end up closing like really strong. And it's done that a bunch here, and I think that's really interesting. And so, and right now, you know, we're basically, it's pushing a new high. I mean, this was the high. I had set it at the top of this wick here, and granted, this is the weekly, and it could still close below it, but even still, it has wicked higher than this high. So this is basically a new yearly high for the dollar index, which I kind of didn't see coming. I was more expecting a lot more downside, particularly when we broke this level. I didn't really see it doing this. But I feel like this is again indicative of the larger macro situation of rates being as high as they are, and bond yields being as high as they are, and liquidity being as low as it is, and just kind of everybody flocking to the dollar and flocking to bonds and things like that. And so that's what you're seeing here with this. Yeah, I mean, here it is reflected too, you know, and this blue chart is liquidity, and it's basically still trending down even this week. And that's why we're seeing, you know, the dollar continue to trend and Bitcoin stay flat. So what that means for stocks, I don't know. It kind of is counterintuitive. Typically, when the dollar is really, really strong, you don't see the stock market's doing well, the equities market's doing well. But maybe it's just that they're oversold, and it just kind of needs to kind of mean revert back to the middle of this band here on each of these, and then continue the downtrend. I don't know. I mean, like, let's kind of just zoom in on one of these and sort of look at what that looks like. I mean, yeah, it is well oversold. So even really, if it just came back to the 20-day moving average, that would still not change the overall trend. And that would actually bump it up a fair bit, you know, like how it's actually really oversold now that I look at it. So, I mean, that would be, what are we looking at here? Yeah, 3.5%. So that's a pretty big move. I mean, yeah, I can do that in a week, but, that could also be all this means, you know, or maybe outside chance it goes up to the top of the bands, kind of like it did in this last time. But honestly, you know, the more I look at this, the more I'm thinking maybe it is just a mean reversion back to the center of these bands. So not going to put a ton of stock in there, no pun intended. What else? Yeah, okay. I think that's all I wanted to look at there. So yeah, let's talk about these other indicators. So a couple, and let me clean up some of this stuff here. Let me get rid of this. Let me get rid of these. Okay. So got a nice clean chart here. Okay. So a couple of them. One is Megatrend. The Megatrend is actually pretty handy. And it does a good job of giving you sort of, particularly I like it on the weekly. Yeah, you can use it on smaller time frames. It's fine on the daily, but it gets a little too noisy on the smaller time frames. Like, just briefly, we can look at it on the daily, and it's just, I mean, it's flipping and flopping every which way. It's just kind of too noisy. But on the weekly, it's actually, I mean, if you look at it here, it's pretty spot on. And honestly, like, if you kind of just based your big, heavy sort of macro, you know, trades off of these, you know, this is a good you would do well by basically just buying when this turns green and selling when it turns red, you know. Even if you go all the way back and look at it throughout Bitcoin's history, you have to be a little careful because it can get kind of noisy. I mean, here you've got it flipping to red on in the middle of a massive, you know, parabolic rally. So that's the thing with these, is you never can just like solely buy and sell based on any one single indicator, because it's always going to give you too much noise. Here's another good example of like, oh yeah, I could have bought here and sold here, and you would have literally done nothing, you know. But I feel like they're really good for confluence, and particularly like in times like right now. I do use a bunch of other indicators, as you know, and I don't have these on all the time, also, as you know, but I do like to pull them up every now and then, periodically, when I do see sort of larger trends shifting. Like I definitely pulled up this and another one that I'm going to look at here in a second. As soon as we close below the 20-week moving average, a month or so ago, because I thought that this was important to kind of, again, get confluence. Like you want to look for a number of indicators that are kind of all telling you the same story, and that's how you get the most insight and generally make the best decisions. I think it's the people that will just follow any one indicator and base their entire investing strategy off of whatever it says that tend to get bitten. Although you could argue, even if you did get bitten here, or here or whatever, overall you did pretty well. Overall, you probably would be ahead in this game still. So this is good. And we did see, and I didn't actually even notice this earlier when it actually did flip, but it has since flipped red on the weekly. And I think that's noteworthy. And it's not even really about like finding the indicator that flips the most accurately or gives you the most precise spot on insight. Because they're all going to be a little bit different. They're all going to tell you a little bit different story. They all have different triggers. But it's still it's interesting. And the interesting thing about this megatrend actually is you can, not that I would advise it, but you can actually, it runs as like a strategy, and you can set alerts and base, like automated trading bots off of its triggers and its changes. And it's pretty interesting, but I just wanted to show it because I think it's good to pull this up and look at it on various charts, really, again, on the weekly level, just to kind of get a sense of what it's saying, because I think it can be insightful. And as you can see, it, if you'd have sold here, you'd have been great. If you'd have sold and been bought here, like that was a really killer signal here, and then sold here, obviously you would have kind of won the cycle, in doing that. And so, I mean, really just, this buy here, this buy here, this buy here, and boom, you're good to go. The other one I really like is this whole suite, which is just kind of made up of a number of sort of moving averages that sort of form this ribbon like this. And it works similar to the megatrend. In fact, I'll put them both up here just so you can kind of compare them. They are different. And they do trigger at different points. And again, to say is one more accurate than the other, I don't know. I mean, again, they have different triggers, and they're gonna be better in different scenarios too. Like here, would you have been better off buying here versus buying here? No. Would you have been better off selling here versus selling here? Perhaps not. But then at the same time, you'd have been better off selling here than selling here, certainly. And you'd have been better off selling here than selling here. So, again, there, some are better. One's better than another in certain situations, and then vice versa. So it's cool to have both. It's cool to look at both of these and compare the two and see where the differences are. And, again, not base all your decisions off of, but I think it's helpful to sort of paint a larger overall picture. I don't keep these on all the time because, as you can imagine, they kind of can muck up your chart, and there's definitely such a thing as information overload. And you could argue that sometimes my charts already have too much stuff on them to begin with, and I don't need these on there either. But I do like to kind of, I think this is a good practice to get into from time to time, is to just clear out your charts and pull up one or two indicators at a time that maybe you don't use on a regular basis, and just kind of look at things from a different perspective. Because it is helpful, and it does give you insight that maybe you don't otherwise get on a regular basis with the standard tool set that you use. So that's why I do this. And I mean, maybe I even have a couple others in here that I look at. I've had some, but I tend to delete them after a while because they don't get used after a certain period of time. So yeah, no, at the moment, those are kind of the big ones. I mean, I do use other things like on this other chart here. I know we've kind of talked about this in other shows in the past, but I also will sometimes use like the Pi cycle, and like for Bitcoin, I'll use this 2-year moving average multiplier, which is kind of another, again, interesting indicator, like the Pi cycle tops. Is this one? No, this one. Oh yeah, this one. So like the Pi cycle top, I'll pull that up from time to time too. Interesting to note that we did actually close below here on this one too, and now it's providing resistance on the monthly, which again, just kind of more confluence that, you know, we're in a downtrend right now and we're battling resistance and not support. So, but yeah, so that's why that right there, that's a perfect example of why you do things like this, you know, just to kind of have more things showing you the same thing is what you want to see. And then you want to, from time to time, start looking for things that are starting to show you different things than what you're typically seeing. And that's when you can maybe identify trend reversals or regime changes and things like that, you know, structural changes. So perfect example of why to do this. Let me go back to this other chart. So yeah, I think these are helpful. So if you want to add them to your slate of indicators. So one is Megatrend. One is Whole Suite by InSilico. I think those are both pretty useful to have. Again, I don't really look at them much on the daily, or, you know, certainly not the intraday. If you wanted to trade off of these, whatever, that's totally your thing. I don't do that. I wouldn't ever do that. But I think, again, on the weekly, stuff like this is really helpful, to just sort of have in your back pocket and pull it out and take a look at it every now and then and go, okay, is this matching up with everything else? Does this make sense? Good. Okay. I know where we're at. And of course, as you can see, you know, these are, add confluence in the sense that, you know, right now we're underneath on both of them. They're both providing resistance, and, you know, it just supports the overall thesis that we are currently in a downtrend. What is this? Oh, never mind. Okay. So yeah, kind of put everything back. Use my standard slate. So right now my standard slate of go-to indicators are the TSMA, which basically just gives me 3 different simple moving averages, and you can toggle them. So right now I've got it on 10, 50, and 20, and I don't think I even have, right now I only have the 10 even displayed. I kind of always like to have a 10 moving average up, like a 10 and a 20 are sort of my go-to, kind of my bread and butter, but the 20 will display by way of the Bollinger Bands, because that's the center of the Bollinger Bands. It'll also display by way of the bull market support band, as long as you're on the weekly time frame. But that's why I don't have a 20 sort of used here. I basically get my 20 moving average from the Bollinger Band itself. So I turn on my TSMA, turn on my Bollinger Bands, and then kick on my Scipio indicators, which are damage indicator by the blood and EIP. And then right now I've got my bull market support band, and that's kind of my core set that I use. And I turn on volume. I toggle volume on and off, but I do have volume on a lot, and volume is interesting to pay attention to. And honestly, I think something you should do, by default, the moving average isn't enabled on the volume indicator typically, and I think it's important to have that and actually kind of make it big and bold, because that really helps you, you know, to see it helps you to see a trend, and if volume is trending up or down. And I think that's important to know. And also another cool thing you can do with the volume indicator is to sort of give you a sense of what the average volume is, so that you can see on any given day if there's more or less, you know, if you're above or below average trading volume on any given day. And so I think that's helpful to know. That gives its own type of insight. And, you know, as you can see, the last couple of days we've actually had slightly above average trading volume, or last couple of weeks rather, which again is helpful to know, because that can give you insight on if you're going to see a trend reversal from a volume standpoint too. So get that moving average on your volume indicator and use it, because I think that's helpful. So yeah, I guess that's probably it. Final thoughts. I'm kind of looking for really more downside in the moment. I don't think, you know, we had the FOMC last week. I don't think there's any big announcements coming up this week that I can remember. So I think we're going to have, combine that with the sort of the level of apathy we're seeing. And I feel like we have a negative week in store for us. And if we look at the global net liquidity, which is still really kind of picking up steam, actually, and trending down, that looks sort of ugly. So if you overlay global net liquidity, it doesn't look good. It doesn't look good for the short term. So, I think I'll end it there. One kind of programming note, I decided to tweak my schedule a little bit. I honestly, the problem is there's just not enough change, throughout the course of the week to do 3 videos a week. And I was struggling to come up with stuff to talk about. So, I haven't had as many guests on lately, as that's going to change. I'm still kind of working on that, kind of working on some ideas of things to talk about with different people. But in the meantime, I've changed it to doing Mondays and Thursdays. So I'm going to do 2 shows a week, one to start out the week and then a final one to kind of, get us into the weekend. And we'll see how that goes. And if I do have a guest on, it'll just kind of be randomly strewn in one of those 2 episodes. So we'll go with that for a while and see how that works. And yeah. So on that note, I will see you guys on Thursday, and enjoy the rest of your week. Talk to you later. Thanks.